What's going on, Z Community Cuties? It's your boy Azizz Finance, and welcome back to the Personal Finance in Canada show, also known as the PFC show. Whether you've been listening to our podcast for a while now, or this is your first time, be sure that you're either following or subscribe to the pod, and share this with somebody who you think will also get value from this podcast as well. Now, without further ado, let's get this party started and dive into the episode. By listening to the PFC show, the Personal Finance in Canada show with Azizz Finance, you acknowledge and agree that me, Azizz Finance, assume no responsibility for any financial decision or decisions that you make, as it is ultimately your finances and you are the only controller of your own decisions. I am a random person on the internet and not a financial professional, so please consult with one being a financial professional before making any financial-based decision, because anything that you hear on this podcast, overall, each and every single episode, is just a sharing of my experience and are not suggestions whatsoever, regardless of the types of language or words that I use within these episodes. Again, by listening to this podcast, you acknowledge that I assume no responsibility for any decisions that you make regarding your finances. Alright, so today we're going to be talking about a very interesting strategy when it comes down to investing in the stock market, and this is dividend investing. Now, there is a category of people who will invest in companies just because it pays them a dividend. Now, these dividends are basically a portion of the profits that a company makes, and it pays it out to the investors of that company. These dividends can either be paid out either monthly, quarterly, which is every 3 months, semi-annually, which is every 6 months, or annually, which is once a year. Not all companies do this, but there are a select few that do, and most of the time it's just to incentivize people to own the stocks and just keep investing with them and to keep buying more of this company's shares to then get more dividends. This type of investing has gained a lot of traction recently just because people look at this as another way of generating income, which could be, but again, also just could be holding you back as well, which is what I'll touch up on later on in this video. So let's break down the pros and cons about dividend investing. When it comes down to pros, depending on how much you invest and the investment itself, it could provide you with a stable and reliable source of income. The reason I say could is because the more you put in, the more you get out. What I see people do is save up a huge amount of cash and invest it within a dividend stock to give them a sizable primary source of income. We'll touch up on this more in the disadvantages of dividend investing though, because there is a catch. Another pro about this type of investing is that it is an extra bonus if you're looking to invest within a company and just conveniently found out that it gives a dividend. Who would turn down free money? And probably another pro is the compounding interest effect. If you do this under a DRIP, which is also known as a dividend reinvestment plan, which again we'll talk about later on in this episode. All of the dividends that you would have received, just a little quick sneak peek though, what this DRIP is all of the dividends that you would have received from this company would just be reinvested back into the stock itself to get you more shares and thus more dividends. Now, some of the cons associated with dividend investing is that dividends can be cut and stocks don't always go up. A notable mention here is that some companies can reduce the dividend that they give out to investors. This would usually happen if the company isn't doing so well, aka you didn't do a good job picking this company as an investment. Also, putting aside that meme of, I don't know who it is, but somebody saying stocks only go up, that is not the case whatsoever. So in the situation where stock prices usually do go down, you will end up seeing a potential decrease in the dividend itself. So it'll eat up your returns, whether that be from the stock or from the dividends that you are used to receiving. Another con about dividend investing is just the time that's associated with it. Now, let's just say that you were aiming to get $50,000 a year worth of dividend income. You'd have to save $1 million. And let's just take a simple example. You were aiming to get $50,000 a year worth in dividend income. You'd have to save up and invest $1 million. And that's assuming that you can find a safe company that has a 5% dividend yield, which is almost impossible unless you find yourself a REIT or real estate investment trust or an MLP, also known as a master limited partnership. Because with these two types of investments, they usually give an average of 5% back in dividends every single year. These dividends are actually named distributions, so they're completely different but the exact same concept. And obviously a lot of us don't just have $1 million lying around, so this could take you a longer time before you can realize your target income of $50,000 a year. I did do some calculations though, and with a realistic amount starting at, let's say, $20,000, and with a REIT that you found that gives you back 5% per year, you would start off for the first month with $83 a month. Then in year 2, you'd be making $91 a month. year 4, you'd be making $101 a month. And then by year 30, you'd be making $370 a month. It might or might not sound promising. Alright, so I don't know if you've heard, but we're on Instagram. We're posting things on a daily basis. So if you're finding value from this episode and you want to learn more about different topics within the financial world, be sure that you follow us, azizz.finance or azizz.finance. Check us out on Instagram, send us a follow, and even send us a DM if you have any questions about anything from the episode or anything else on the page itself. I'll see you guys there. But let it sink in that by year 30, you would have made $69,354.89 in interest alone. Interest in this case would just be from the dividends itself, and this would be a 246% return, literally by doing nothing aside from reinvesting your dividends. Now, the next segment of dividend investing is compounding interest. So let's just say that you reinvest your monthly dividends back into the same dividend stocks, but on top of that, you're also making an addition of $100 a month to boost your investment. Your numbers will literally skyrocket at one point, because let's just say, we're still operating on your 30-year time frame, and the $100 a month on top of your initial $20,000 investment. Now let that sink in. By the end of the 30 years, you would have made $116,580 in interest alone. So basically $120K in dividends over 30 years. And on top of that, your initial investment of $20,000 would have also increased to about $36,000. I don't even need to do the math for you in terms of percentages. It speaks for itself. The one thing to remember about this, though, is in order to actually realize this, you have to be consistent and you have to be extremely patient, because time is on your side, and in this case, it's kind of like a ticking timer. And once the timer goes off, your money starts multiplying more than bacteria. Now, this strategy of dividend investing is really best for 3 types of people. Those who have a lot of money that they can, diversify and stash across different investments. Those who like a company on a fundamental level rather than just for its dividend. And then those who are trying to build up a retirement fund that's within a separate account, such as an RRSP or a TFSA. Keep in mind again that the average dividend yield of regular companies are between 1 to 4%, and for MLPs or REITs, the average is around 4 to 6%. Anything higher than both of these ranges for either types of investments is pretty abnormal and should raise red flags. So if you see these, make sure that you do a pretty solid analysis before putting your hard-earned cash into this. Unless there's like a collective market crash as we've seen in 2020, then that could be a different case scenario. For me personally, I've been dividend investing ever since I've kind of gotten into the stock market, but I keep everything within a separate account so that I don't really pay attention to it or get emotional. All I do is just put my consistent contributions and let time do the rest. Alright, Z community, that's pretty much it for today's episode. Now again, if you did find value from this, be sure that you're either following or subscribed to the podcast so that you're up to date with new episodes that are going to come your way. On top of that, if you feel like either your friend, your parents, your grandma, your grandpa are going to benefit from this episode or this overall pod, be sure you swing it their way, because at the end of the day, it could just be a nice little early Christmas gift or something. But nonetheless, guys, it's your boy Azizz Finance signing out. I'll see you guys on the next one.